Happy 21st birthday to the HSA when President Bush signed the Medicare Prescription Drug Improvement and Modernization Act into law to establish the health savings account way back in 2004. And it is now legally allowed to drink. But like the thumbnail says, if I had to choose between the HSA and a Roth IRA because my life is at stake, then I would choose the HSA, and let me explain why. And I know, you've probably watched like 5 or 10 HSA videos on YouTube about how you need to invest the HSA this and invest the HSA that, but I want you to forget about the FIRE movement for 1 second and listen to this, because here's the brutal truth. Medicare and Medicaid Services, or CMS, is already reporting that the cost of healthcare is going to outpace the average GDP growth by the year 2032. America has high rates of obesity, heart disease, stroke, and diabetes. Even if you're a healthy person right now, like me, you never know what diseases you may encounter when you're in your 40s, 50s, or 60s and beyond. And I'm sure I'll have some problems in the future because I was one of the lucky ones to work in a burn pit in Iraq when I was on active duty, and I'm just waiting for that day to come. Who knows? Maybe I'll just be fine. And according to Fidelity Investments, the average 65-year-old couple can expect to spend an average of $315,000 on just healthcare expenses throughout their retirement. And this is absolutely insane, because if you're just living on a Social Security pension, your healthcare costs could eat into your pension income. And what if you have a major surgery that costs you tens of thousands of dollars? And obviously, I'm not here to state the obvious by talking about the broken healthcare system we have in the US, because then this is going to turn into an hour-long video. I'm just going to focus on the HSA for this video, okay? And here's what I want you to do. I want you to be ready for the unexpected. For me, it's not just about investing in the HSA, because I'm looking at my healthcare situation with a bigger picture. What investment vehicle can I use to make sure I have enough to last my retirement? And that's when I realized how important the HSA is to my financial independence journey. But first, let me tell you in 30 seconds what an HSA is. Go ahead and time me. An HSA is basically a triple tax advantage secret weapon for covering medical expenses. You contribute in pre-tax dollars, which lowers your taxable income, so your money grows tax-free. And when you use it for qualified medical expenses, boom, you get zero taxes on withdrawals. It's like getting a discount on your healthcare plus an investment account all in one. If you get your HSA contributions deducted directly from your paychecks, you're also going to save another 7.65% in Social Security and Medicare taxes. So in a way, you could get quadruple tax advantages. Was that 30 seconds? Let me know in the comments down below. But for you to contribute to an HSA, you have to first enroll in an IRS qualified high deductible health plan, or HDHP. And I'm going to say HDHP throughout this video, but at least you know what it stands for. Now, I know high deductible sounds about as appealing as a surprise root canal, but hear me out. The IRS sets the deductible limits each year. And for the year 2025, the minimum deductible for an individual is $1,650 and $3,300 for a family, while the out-of-pocket maximum is $8,300 for individuals or $16,600 for a family. The HSA contribution limit for 2025 is $4,300 for single individuals and $8,550 for families. The other awesome thing about the HSA is that you can still contribute to your 2024 HSA before the tax deadline on April 15, 2025, but only if you were covered by the HDHP in 2024. So if you were not covered by the HDHP in 2024, then you cannot go back in time to contribute to it. But if you were, and you didn't get to max it out, you can still go back to contribute up to the 2024 limit, as long as you're watching this video before April 15th, 2025. So be sure to subscribe to my channel to not miss anything if you haven't done it already. And what if you were covered partially throughout the year? Remember these key terms: the HSA last month rule and the testing period from the IRS publication 969. And it requires you to be eligible for an HSA on the first day of the last month of the tax year. And for most people, the day is December 1st. It doesn't matter if you were ineligible for any other months. However, you have to maintain your HSA eligibility for a set period of time after you take advantage of the last month rule. And this is also known as the testing period, which runs from December 1st of the year you became HSA eligible through December 31st of the following year. So for example, let's say you start your HDHP family coverage with your HSA on December 1st. if you decide to make a lump sum contribution in December for $8,550 and you keep your HSA eligibility until December 31st of the following year in 2026, then you're good to go. But if you become ineligible for the HSA, and let's say in August 2026, because you lost your HDHP coverage, then $712.50 from the 2025 tax year is the only eligible contribution, and the remaining $7,837.50 will be subject to federal income tax, state income tax, and a 10% penalty towards it because you failed the testing period. But what if you start your HDHP coverage in March 2025? Then obviously you cannot go back to the 2024 HSA contribution because you weren't covered that year. However, you're going to need to prorate your contributions for 2025. So if you're starting in March, then you can prorate your contributions by 10 months. So you just do $8,550 for the family coverage, divided by 12 months, and then multiplied by 10 months for the prorated contribution limit. In this case, it will be $712.50 multiplied by 10 months, giving you $7,125 for the tax year 2025. And if you're single, then the 10-month coverage will allow you to contribute up to $3,583. And that makes sense so far, right? And if you're turning 55 in the tax year 2025, you can contribute an additional $1,000 to your HSA. So what if you don't turn 55, let's say until December 31st, 2025? That's okay. You can still contribute $1,000 throughout 2025 because you're going to be 55 by the end of the calendar year. And remember that under the family coverage, only one person can contribute that extra $1,000, and that's based on whoever owns the HSA. So if you're 55 but your spouse is 54, you can do the $1,000 in catch-up contribution if you own that HSA. But if you and your spouse are both 55, you can still only do the $1,000 in catch-up contribution, not $2,000, unless you and your spouse have two separate HSAs. It's a dumb rule, but it is what it is. Now, while HDHPs typically feature lower premiums, not all qualify as HSA eligible. So for example, with an HDHP, non-preventive services are not covered until the annual deductible is met, meaning you're going to need to pay the full cost of the service out of pocket until you reach the annual deductible amount. That makes sense so far, right? Remember, that was the non-preventive one. Something else to keep in mind is that you cannot be enrolled in Medicare, have non-HDHP health coverage, or be claimed as a dependent on another person's tax return. So if you're on active duty or retired from active duty and enrolled in TRICARE, you're not going to be eligible for the HSA. Why? Because TRICARE is not an HDHP. Also, HDHPs have to cover preventive services like screenings, vaccinations, which are pre-deductible without jeopardizing HSA eligibility, to make sure that essential care remains accessible while balancing cost-sharing trade-offs. And I actually wrote a letter to my congressman and senator about how the HSA contribution limits don't match the annual deductibles, and I still haven't heard back from them. And I'll try them again soon and see what happens. Waiting for Congress to write me back is like waiting for my long-distance girlfriend to write me back on AOL Instant Messenger. By the way,
you've got mail.
If you know ASL, you're really showing your age. But anyway, do not confuse the HSA with FSA, because unlike FSAs, which force you to spend your balance before it disappears, HSAs have no use it or lose it rule, and your money rolls over after you're growing tax-free and there's no deadline to spend it. And this means you can let your HSA build up over time, invest it, and only pay for what you need, like the Liberty Mutual commercials, whether that's next year in the decade or even in retirement. So allow me to demonstrate how FIRE investors do things differently with their HSAs from the regular people using their HSAs. Now, what if you pay for that unexpected medical bill with your cash reserve instead of your HSA? Then you can consider it a loan to yourself for the future. And the thing is, as long as you keep the receipt, you can reimburse yourself from the HSA at any time, even years later. Did your child get braces in 2025? Let's say it cost you $3,000. You can reimburse yourself that $3,000 in 2045 from your HSA and use it for whatever you want. And just imagine how much that $3,000 could grow in your HSA if you waited for 20 years. Because $3,000 in 20 years with no additional contributions at an 8% average annual return is almost $14,000. And the $11,000 in earnings, capital gains with dividends are considered tax-free growth. So again, the key is to leave the money in the HSA so that it can stay invested with an index fund, ETFs, or other mutual funds. If I took that $3,000 out, then that's not going to grow any further in the HSA, right? But whatever happens, just keep those receipts, because that is the golden rule of HSA. Because if you don't have a receipt, the IRS is going to assume that it is a non-qualified distribution for a non-medical expense, so that $3,000 that you're supposed to get tax-free is now $2,400 because of the 20% penalty. That's right. It's not the 10% penalty like the IRA or 401k, but it is a 20% penalty with the HSA. On top of that, you're going to owe federal and state income taxes for that $3,000. So you need to make sure the receipts are saved somewhere safe. I scan all of my receipts and categorize them in numerical order based on the year, month, and days. And I also write down who the provider was and what it was for. So the downside is really just learning to organize your receipts so that you can get reimbursed in the future. If you're not about that life, then this hack may not be right for you. But here's a fun twist. Once you hit 65, your HSA gets a major promotion. It's no longer just a medical expense fund. It transforms into a retirement account. And at that point, you can withdraw money for anything: vacations, home renovations, even that dream RV, without worrying about the dreaded 20% penalty. The only catch, you'll pay regular income tax on non-medical withdrawals just like you would with a traditional IRA. But considering you got all those tax-free contributions and tax-free growth along the way, it's still a sweet deal. Now, here's where things get more interesting. Remember how I told you that you're contributing to your HSA with pre-tax dollars? So think of this step like putting your money into your traditional 401k or your traditional IRA. It lowers your federal and state income taxes. The only exception is if you live in the state of California or New Jersey, which means that you're only going to save on the federal income tax if you live in California or New Jersey and not their state income taxes. I've seen the California income tax rates, and I don't know how people are paying so much taxes in that state. And let me know in the comment section down below if you're living in California or New Jersey. But anyway, if you're in a 24% marginal tax rate, every $1,000 you contribute to your HSA really costs you $760 because you're saving on taxes up front. That's like walking into a store, picking out a $100 item and only getting charged for $76 without needing a coupon or a secret handshake. I don't know. And once the money is in there, your HSA will allow you to invest your funds in stocks, bonds, or mutual funds similar to a 401k or IRA. This means your money isn't just sitting there. It's growing over time, but keep in mind that some HSAs have very limited investment options. So be sure to do some research before just picking a random HDHP that you've never heard of. However, most HSA providers require you to keep a minimum cash buffer. Some HSA requires you to have $1,000 and some HSA requires you to have $2,000 before you can invest the rest. But once you clear the hurdle, your HSA morphs into a turbocharged retirement sidekick. Contributions are tax-free, growth is tax-free, and withdrawals for medical costs, even decades later, are tax-free. Now, here's something I always tell my clients in pursuit of financial independence and early retirement. The HSA is not just a savings account, it is a secret weapon. By maxing out contributions and investing in stocks or ETFs instead of letting cash idle, you can turn the HSA into a long-term growth engine. Why? Because it's one of the most tax-advantaged accounts out there, and when you use it strategically, it can supercharge your financial freedom. And this is why maxing out the HSA is on step 6 of my financial independence checklist. And maxing out my HSA has always been my priority because, again, it lowers my tax rates. The Roth IRA doesn't allow me to lower my tax rates because I'm contributing to my Roth IRA in after-tax dollars straight from my checking account. My game plan is simple. I don't touch my HSA. Instead, I let my funds sit, grow, and compound over decades while I cover my current medical expenses out of pocket. But here's the trick. Letting those investments compound for decades means my HSA is not just covering healthcare, it's quietly growing into a 6-figure safety net. So once I hit 65, I'll tap it for Medicare premiums or reimburse myself for all those old bills, tax-free. But if by any chance you're feeling overwhelmed by all the information, you can always schedule a consultation with me by visiting firestarship.com/consultation, and I'll be more than happy to walk you through this step by step. Now, designating a beneficiary for your HSA is more than a financial formality, and it's a heartfelt gesture that ensures your loved ones are cared for even after you're gone. By naming your spouse as the beneficiary, your HSA seamlessly becomes theirs, and which allows them to continue to use their HSA tax-free for qualified medical expenses. If you choose a non-spouse beneficiary, such as a child or someone else in your family tree, they will receive the account balance as taxable income in the year of your passing, which provides them with immediate financial support during a challenging time. But that HSA could also raise their taxable income for the year. So please keep that in mind when you designate your HSA beneficiaries. Taking the time now to assign beneficiaries is a simple yet profound way to extend your legacy of care and support to those who matter most to you. And here's the thing. HSAs are not just another boring savings account. They're a wealth building, tax saving, retirement boosting powerhouse if you use them right. Future you is either going to thank you for making smart money moves today or curse you for missing out on tax-free benefits. So let's make sure it's the first one. Take control of your finances, keep more of your hard-earned money, and let your HSA work for you, not just sit there. And be sure to check out this video about the new HSA rules that allow employers to put the employer match in your HSA instead of your 401k. And this has been another beast of a video, and I hope you got a lot out of it.